All right, imagine this. You own a car that's currently worth $10,000, but you're a bit worried that the value might drop in the next month. Maybe there's some new model coming out, or the market is just shaky, and you're concerned that soon it might be worth a lot less. So, what do? You decide to buy an insurance policy on it. This insurance policy says that if the car's value drops below $10,000, you still have the right to sell it for exactly $10,000. In other words, no matter how low the car's market value goes, you've locked in that $10,000 selling price. This gives you peace of mind because you're protected from any big losses. This type of insurance is similar to what we call a put option in the investing world. Just like the insurance policy protects you from losing money if the car's value drops, a put option protects you from losing money if the value of a stock or another asset falls. So let's take an example with a stock. Suppose you buy a put option for shares of XYZ company, which is currently trading at $50 per share. You're concerned that XYZ's price might drop soon, so you buy a put option with a strike price of $50, which is the price you can lock in to sell the stock if you need to. Let's say the option costs you $2 per share, which is like paying for that insurance premium. Now you have the right to sell XYZ stock at $50 anytime within the next month, no matter what happens to its actual market price. If the stock's price falls, you can exercise your option and sell it at the higher $50 price. But if the stock's price rises or stays the same, you can just let the option expire and only lose the $2 you paid for it. Let's walk through two scenarios so you can see how this works. Scenario 1, stock price falls. Say the price of XYZ falls to $40. Now, because you bought the put option, you can still sell the stock at the strike price of $50. Even though the stock is worth only $40, you get $50 thanks to the option. That's a profit of $10 per share minus the $2 premium you paid, so your total profit is $8 per share. Scenario 2, stock price rises. But what if the stock price goes up to $55? In that case, you wouldn't want to use your option to sell at $50 because you could sell it for $55 in the open market. Here, you would just let the option expire and lose the $2 premium you paid, but you wouldn't suffer any loss from the stock price drop because it didn't drop. So, a put option is a powerful tool for hedging against losses if you think an asset might go down in value. It's a kind of insurance that lets you protect your investment from big drops. And for traders, put options are also a way to profit from declines in the stock's price, even if they don't own the stock. In short, a put option gives you a right to sell at a set price. It's not an obligation. You can decide whether or not to use it, depending on what's best for you. It's a handy tool in any investor's toolkit, whether you're protecting your investments or looking for opportunities when markets move.